I said after last Friday's jobs number that the establishment survey was just wrong. The only real question is by how much. As it turns out, Fed Chair Jerome Powell actually agrees with that statement. And that's not all. Mr. Powell yesterday said he doesn't have a clue why people are so downbeat about the U.S. economy. As if questions about the veracity of the payroll estimates that he and others have been using as proof of a strong labor market don't help answer this puzzle about why Americans aren't bracing the idea of a booming economy. Maybe they know the real economic and employment situation is closer to the other data like the unemployment rate, a growing list of evidence pointing to recession. And that's on top of past price increases that the public has got the sense they're never going to get back that purchasing power. Any chance to reclaim it via an actually robust labor market has disappeared with the credibility of the payroll report. The FOMC raised its dots yesterday anyway, and more importantly, the bond market didn't care. At least most of the market. This isn't hard to figure out. The economy isn't strong, resilient, booming, or anything of the sort. Worst of all, it's getting worse. Jobless claims, producer prices, further falling yields, angry Americans, a slightly truthful yet mainly befuddled group of Federal Reserve policymakers, and that's just the last 24 hours. Interest rates. As I mentioned yesterday, after yesterday's CPI, interest rates are going lower. They want to go lower, and they are continuing to go lower. We got jobless claims today, the PPI, and the aftermath of the dots, which didn't have much of an impact on the Treasury market. As of last check, the 10-year's at 424 and still moving lower. The 2-year at 467. Now, those were down yesterday about the same level. Then they backed off with the hawkish Federal Reserve statement in the meeting. But they're right back down again, even though the Fed says, or the Fed sees, fewer rate cuts from the FOMC this year. What the infamous dots showed, at least the median for the SEP in the month of June 2024, was that policymakers as a whole only expect about one rate cut this year. That's down from 3 that they had penciled in March. So it's very clear they got spooked by previous CPIs, and it's going to take them quite a while to be unspooked, even if we get more like the CPI in May. Because they're always looking backward at the number that's coming in, never really able to look forward and understand and really appreciate where things are going. Maybe they need to listen to the public more instead of telling them what to think. While longer-term Treasury yields have been able to go much lower because they're more free from interference from the front end of the Federal Reserve, short-term Treasury rates, they remain fixed because the market isn't ready yet to trade directly against the Fed's dots in this short run. After all, they say that they need more confirmation of the CPI or some serious deterioration in the labor market, which we'll get to in a second. However, short-term rates remain relatively stable where they've been while the long end continues to go back down and retrace basically the last several months because the historical pattern remains in the Treasury market. There's the big rally last year, then it goes sideways to slightly higher for several months while it looks for confirmation of the fundamental reasons for that rally in the first place, and then an entry point into the next leg lower. That's what we're seeing in the marketplace today. Confirmation of all the fundamentals that were suspected last year, as well as what appears to be an entry point into the next leg. And that's something that we're going to talk about here at Eurodollar University on Friday, June 28th at 6:30 p.m. We're going to talk about the fundamentals of interest rates as we celebrate Eurodollar University's second anniversary. We'll start with why it is fundamentals that drive rates and not this mainstream nonsense about supply versus demand. What those fundamentals are and what they might look like over the next 12 months. And this is what we get into in Eurodollar University's deep dive analysis. It's also, I write updates every day at our daily briefing, and we get the whole background behind Eurodollar money and curves in our Eurodollar University memberships. You can sign up right now for our webinar. There's a link in the description. And I'll let you know about the details behind Eurodollar University's anniversary sale on the memberships and subscriptions as we get closer to it. Again, link in the description for the webinar. I hope to see you there. At his press conference following the FOMC meeting and the statement that was released with it, Jay Powell was asked a question about why most Americans don't seem to be all that happy with their situation. And he replied, "I don't think anyone has a definitive answer why people are not as happy about the economy as they might be." And this sets up a dichotomy of opinions about where things actually stand. If you go by the mainstream economic statistics and numbers like GDP, and it used to be the unemployment rate, though that has turned against the narrative as well, but the payroll report most of all. You look at the economy from the perspective of the payroll report and you think, it is absolutely booming. Why are people complaining? And when we see high payroll levels, that usually corresponds with robust economic conditions in a widespread fashion. So if the payroll report is booming, it looks really good, then people should be happy about the economy that usually associates with a booming payroll number. The truth is, survey after survey, data point after data point, sentiment, everything else in between, voting patterns, they all suggest that people in the United States and around the rest of the world too, as I talked about in a recent video in Europe, they are not happy about the way things are going or the way they've gone and what that means about the future. As one article in Politico put it just last week, if half of the people think that unemployment is at a 50-year high when it's actually close to a 50-year low, this is a problem of misinformation. It's a problem of perception, said Ben Harris, a former senior Treasury Department official who helped craft Biden's economic agenda. I think, unfortunately, it'll have a major impact on the election. So basically, people are wrong, and they're being fed misinformation about how great the economy actually is, being told that it actually isn't good. And the statistic he refers to here is an actual statistic from a poll that was put together by the Guardian newspaper over in the UK, specifically asking about what Americans know as far as the economy. And that survey uncovered these, what seemed to most people, startling results. Nearly 3 in 5 Americans wrongly believe the U.S. is in an economic recession, and the majority blame the Biden administration, according to a Harris poll conducted exclusively for The Guardian. This is May 22nd, just last month. The survey found persistent pessimism about the economy as Election Day draws closer. And some of the numbers, 55% of Americans believe the economy is shrinking, and 56% believe the U.S. is experiencing a recession, though the broadest measure of the economy, gross domestic product, has been growing. So more than half of the Americans think that we're in a recession when GDP is positive, so half of America is filled with idiots. And these idiots also believe, 49% of them anyway, believe the S&P 500 stock market index is down for the year, though the index went up about 24% in 2023 and is up more than 12% to that point this year. Furthermore, 49% of Americans in this poll believe that unemployment is at a 50-year high, though the unemployment rate has been under 4%, a near 50-year low. But the unemployment rate has been rising, and I think that offers us some clues and some windows and insight into what's actually happening here. Now, the poll was obviously commissioned to make the American public opinion look as bad as it possibly can. So all of these people, like Jay Powell, can laugh under their breath and say these idiot Americans don't know how good that they have it. But in reality, there's more truth to these poll numbers than they're letting you think, or allowing themselves to actually believe and understand. Think about it. Most people don't closely follow the economic statistics. But if they believe, or they start to see maybe their neighbor loses their job, a family member, a distant family member loses their job, they might have the impression that the unemployment rate is at least moving in the wrong direction, and maybe it's too high if more than one person they know is actually become unemployed. So it isn't a stretch to think that more and more Americans that are seeing in their daily lives rising level of unemployment and joblessness might associate a higher unemployment rate with what they're seeing. And as more Americans are seeing the same thing, it leads to this poll result. Same thing with the stock market. If you don't follow the stock market closely, you just have a 401k or something, and you see individual stocks in that portfolio that don't seem to be doing all that well, and only a few very large cap, magnificent stocks that are actually hitting record highs, your perception of the stock market may not match the primary benchmark that we all use, these indexes. Maybe you think that stocks are down because in reality, most stocks might actually be. People are smart enough to understand these distinctions. If the labor market was really booming, they wouldn't be as dissatisfied about prices, and that's the thing that keeps coming back up. Most Americans are dissatisfied over the price situation, and what they're really angry about is they can sense they're never going to be made whole. They fell far behind after the supply shock and the pandemic, the unleashing of huge price changes, and they are more and more realizing as the economy appears more and more recession-like that they're not going to be able to make up that gap. I mean, you wouldn't like paying 40% more for groceries, but if you saw a path forward that reduces or even eliminates that imbalance, the level of dissatisfaction in the general broader economy would be materially different. People see the price increases and they focus on the price increases, but the other part that everyone is ignoring is they also see that the path to alleviate them is disappearing all the time. That's the recession part of it. Maybe the US isn't technically in recession according to certain statistics, but according to most people's perceptions and a whole lot of data backing them up, it actually is closer than not, if not already in it. I continue to believe we're at half a recession, and I actually think it's now 3/4 of a recession. So if you're someone like Jay Powell or any politician and you keep pointing to the payroll report and saying this terrific, sterling, awesome jobs number proves that you're wrong about your perception of the economy, and then you come out and say this awesome jobs number isn't as awesome as we've been saying it is, it does a lot more than hurt your credibility. You're also saying that maybe there's more to this perception than you're willing to concede. At his press conference yesterday, Mr. Powell was asked about the payroll report, and he said, there's an argument that they may be a bit overstated, but still, they're strong. We see gradual cooling, gradual moving toward the better balance. So like I said last Friday when the payroll number came out, it is wrong. The question is by how much? So Powell basically agreed that yes, it's wrong, but he doesn't see it being wrong by all that much. A less significant difference between reality and what the prior estimates had shown. And he's not making this admission out of nowhere. He understands, given the QCEW and other recent data reports, which strongly suggest, that the establishment survey indeed has been overstating the jobs market. He says it's just a bit overstated, but of course he's downplaying the overstating because that fits his narrative. But so, in his position, he's saying, so what? If the job growth last year was 250,000, does it really make a huge difference if it was only, say, 190 or 180? And on the face of it, it seems like, okay, that wouldn't be a material difference, but it actually is. If we're talking about revising down the CES by 60,000 a month, as some estimates have suggested, that's 700,000 jobs that were never gained because they never actually happened last year. But it really matters if those phantom job gains were concentrated in the second half, as the QCEW actually makes it seem. But the QCEW is not the only data source. There's others. Something called the Business Employment Dynamics Summary, or BED. Here's how it's described. The change in the number of jobs over time is the net result of increases and decreases in employment that occur at all private businesses in the economy. Business employment dynamics statistics track these changes in employment at private sector establishments from the third month of one quarter to the third month of the next. The difference between the number of gross job gains and the number of gross job losses is the net change in employment. And where the BED numbers actually, they're potentially superior to the establishment surveys because they do count what the establishment survey tries to in its birth-death model. That is the emergence of new firms as well as the extinction of firms that go out of business. But because this is a comprehensive data set and it looks at a whole bunch of information, it comes out in very delayed fashion. So in April of this year, we're just getting these employment statistics through the third quarter of last year. And I believe in July, we'll finally get the fourth quarter of last year. So we're talking about 6-7 months behind. But it is less prone to the subjective assumptions that go into the establishment survey and payrolls. For example, the last BED survey, the last BED results for the third quarter of last year showed that the difference between the number of gross job gains and the number of gross job losses yielded a net employment decline of 192,000 jobs. Let me say it again. A net employment decline of 192,000 jobs in the private sector during the third quarter of 2023. And you look through their tables and you can see how it looks like the economy definitely decelerated through the third quarter of last year. In September of 2022, third quarter of that year, they found 1.34 million. Remember, this is a quarterly change, not a monthly change, so quarterly change. In the fourth quarter, it was 500,000. That's December of 2022. That picked back up in the first part of 2023 by 976,000 as the disinflation rebound took hold. And then it slowed down materially. June, just 332,000 net. That's about 100,000 a month. And then September, minus 192,000. Now, we have to recognize that September, especially in the more recent statistics, more recent years, tends to be the weakest month in these surveys. In fact, you see a negative number in 2017, a small positive in September 2018, and then a small negative again in 2019. But September 2023, don't want to put too much stock on the negative, but the fact that it was more negative than any of those three pre-pandemic years suggests even weaker than those three pre-pandemic years, which were not robust at all. So the business employment dynamics statistics are again another data point, another series that shows the establishment survey is wildly overstating the jobs market. Then there's the data from today, which suggests that the jobs market, however overstated it has been, might actually be changing. In other words, jobless claims. That what we're seeing in the unemployment rate is actually showing up at the unemployment line. According to the Department of Labor, weekly initial filings for the last week was 242,000, which was up from 229,000. And it's been moving higher, noticeably higher, still at a relatively low level, historically speaking, but moving noticeably higher over the last couple months. And now initially when jobless claims had increased, the media said that was all about New York City schools in recess, just bus drivers who were filing for unemployment because they're eligible to do so when New York City schools aren't paying them. So jobless claims went down a little bit, but now they're coming back again in 242,000. That's a multi-month high. Continued claims moved up for the sixth straight week to 1.82 million. So it looks like jobless claims are deteriorating somewhat substantially. We have to keep an eye on it to make sure. But it's another point that's consistent with the unemployment rate, the household survey, indicating that whatever there was last year of job gains, it's materially different in 2024, which brings us back to the overall context. So for the last however long here, Jay Powell has been talking about how great the employment market is because of the establishment survey and its payroll figure. Now all of a sudden he says, well, the payroll figure is a bit overstated, therefore we're not really sure how great it has been, but trust me, it's still great. So he has no idea why the American public would be unhappy. Meanwhile, the American public has been impoverished over the last several years by price changes and the fact that the labor market never actually recovered. Income certainly never came close to making up that difference. And now they're seeing the potential path that could get them back to being made whole slowly, and maybe more quickly disappearing in front of them. He says the labor market's strong, but most people, they don't see it that way. And even though these polls are commissioned to make Americans look stupid and ridiculous, there's probably more truth in these poll results than we are giving them credit for. Certainly the marketplace feels that way, which is why at the end of the day, the end of yesterday, the dots didn't matter. Treasury yields are falling lower because the economy is not the establishment survey. We've at least established that much. As I said, it is wrong. The question is by how much. But the majority of evidence, the vast majority of evidence says it's not just a little bit wrong. It's likely a lot wrong. And it is getting more wrong by the day. The May CPI report was all sorts of bad news, even though it looked like good news. I broke down the details in the video link below. As always, thank you very much for joining me. Check out our webinar. Sign up for it. Link in the description. Thanks to Eurodollar University members and subscribers. And until next time, take care.